Good afternoon, everybody. This is Josh Mindlin here at Chaikin Analytics, and I'd like to welcome you to our presentation of how to find winning stocks in today's volatile climate. Joining us tonight is Marc Chaikin, the founder and CEO of Chaikin Analytics, and Ed D'Agostino, publisher of Mauldin Economics. As a reminder, this webinar is being recorded, and a copy will be sent to all registrants. Please submit your questions via the Zoom Q&A window, which you can access in the upper left-hand corner of your screen. Before we get started, I'd like to welcome Ed D'Agostino to the webinar. As I mentioned, Ed is the publisher of Mauldin Economics, as well as a consultant to the financial sector. Ed joined John Mauldin in 2012 to build a strong editorial research and analytics team. To get us started, here's Ed.
With the return of volatility in the markets, we've had lots of readers asking us for tools that they can use to vet their trading ideas. And that's when I knew it was time to have Marc come back and join us again for another presentation, because this is the type of market environment where Chaikin Analytics really adds a lot of value. So for listeners who don't know, we've been working with Chaikin Analytics for about 3 years now. John Mauldin personally introduced me to Marc, asked me to take a look at his system. Marc was kind enough to set me and our analyst team up with subscriptions, and we put the system to the test. We've evaluated over the past 5 or 6 years at least a dozen of these types of systems. Frankly, this is the only one to not just meet our expectations, but to exceed it. So our analyst team now uses Chaikin Analytics as part of their normal workflow. I use it personally. I find it saves me a lot of time when I'm looking for investment ideas. I just don't know of a better service that delivers so many data points in such a simple, easy to use format. So let me just tell you a little bit about Marc, and then I'm going to get out of the way. Marc spent 40 years on Wall Street as a trader, a stockbroker, an analyst. He was the head of the options department for a major brokerage firm. His system, the Chaikin Power Gauge, is based on a 20-factor alpha model that's proven effective at identifying a stock's potential. A few of the other things that he's done: he pioneered the first real-time analytics workstation for professional investors. That's now part of the Thomson Reuters institutional workstation. He developed a computerized stock selection model and technical indicators, including the Chaikin Money Flow. Several of these are now industry standards. And Marc, you recently partnered with NASDAQ and Index IQ on some ETFs, right?
That's correct, Ed.
And those, from what I understand, have actually outperformed their benchmarks.
They have significantly outperformed. There's now $800 million in 2 ETFs that are just now a year old. One of them's a year old. The small cap, the large cap was launched in December. So everything that your subscribers are going to hear in this webinar is actually being put to work in the marketplace every day.
That's an impressive amount of assets under management for under 1 year. So thank you for joining us, Marc. I'm going to turn it over to you.
Thank you so much, Ed, for that warm introduction. And this has been a wonderful relationship. I had the privilege of being out at the annual conference in San Diego this year that John Mauldin and Ed put together. And I have to tell you, to be in the company of people like Jeff Gundlach, the largest bond manager in the world, Lacey Hunt, probably the smartest analyst about the Fed and so forth, makes me feel humble. But I also feel confident that what we do at Chaikin Analytics resonates with the Mauldin community. We had so many subscribers at this conference in late January in San Diego, advisors, individual investors who have been using Chaikin Analytics under the umbrella of Ed and John and their research team, providing the sort of macro view. We also provide a macro view, but it's primarily about sectors, industry groups, and individual stocks. So in this afternoon's webinar, we're going to talk about finding winning stocks in today's volatile climate. Since so many of you are new to Chaikin Analytics, I'll just take a few seconds to expand on Ed's kind introduction. I've been on Wall Street for over 50 years, and for 45 years, I've been using technical analysis. but always in conjunction with fundamentals. Fundamentals drive the market. That's a core tenet of what we do at Chaikin Analytics. I think that's why Ed and his research team are so comfortable with what we do and with them using it themselves. Because I've used technical analysis, I've been able to survive 10 bear markets. You cannot survive a bear market without technical analysis because fundamentals just won't be enough. Along the way, I've been mentored by some of the smartest and most successful institutional investors. Some of them were clients and some of them were colleagues. And everything I learned from these institutional investors, we had an institutional brokerage firm in the late 80s where we were basically teaching people how to incorporate technical analysis into their fundamental discipline. Everything I learned from these institutional investors, names you would know, went into creating the Chaikin Power Gauge rating. As Ed said, it's a 20-factor model. It's a fundamental model. It's the culmination of my life's work. I came out of retirement after the financial collapse of 2008 to create something that both individual investors and professional investors could use because people were confused and angry. They lost 40 to 50% of their capital, hard-earned retirement plans. My wife was in that situation. She came to me in 2009 and said, I've worked so hard to build up my retirement plan and now 50% of it is gone. There has to be a better way. And I said, there is, and we're going to start Chaikin Analytics. I'm going to fulfill my life's dream, which is to create a predictive model that is easy to use but powerful in terms of finding stocks to invest in and trade, and more importantly, finding stocks to avoid, identifying those landmines that can blow up and destroy your portfolio performance. So in today's webinar, we're going to look at 5 keys to successful investing. I'm going to show you how to find bullish and bearish stocks using the Chaikin Power Gauge rating and our proprietary relative strength indicator. I'm going to show you how to use Chaikin Money Flow. Now, I know a lot of you know Chaikin Money Flow. It's on everybody's online brokerage platform. If you're a professional investor and you use Bloomberg or Reuters, it's been on those terminals for over 25 years. And we're going to show you how to use disciplined entries and exits to time your investment decisions and also your trading decisions, because as Ed said, it's a volatile market. And in a volatile market, there are trading opportunities as well as investment opportunities. We're going to look at how to play good defense, how to avoid landmines that destroy portfolio returns, and finally, how to profit from volatility. But before we get into the individual stock, industry group, and sector analysis, I'd like to sort of put the market into context, because you need a context in a volatile market in order to make sound investment decisions. So what's happened is that we've gone from an uptrend on autopilot in 2017 to a roller coaster of a correction. Now, it started out as a pullback. We're looking at a 1-year chart of the SPY. This is the ETF that tracks the S&P 500 index. It's also the most actively traded instrument in the US markets, and it gives you a perspective about what smart money, big money, is doing. The reason is that institutional investors use the SPY as an inexpensive way to get exposure to equity markets when they have cash to put to work. Let's say they sold 5 million shares of IBM, you're Warren Buffett, and you want to put that money back into the market, but you may not have a favorite stock to buy right now, or it may take time to accumulate that position. So you can see on this 1-year chart, if we start at the left, and we're looking at Chaikin Money Flow, that we had that wonderful steady uptrend until December and January when it went ballistic. This is called a French curve in technical analysis. And when you get a move like this, you know you're going to get a correction. The problem is you don't know when. So we got this wonderful uptrend in 2017 that culminated in an 8.5% move in January to the peak on January 26. And then what started out as a pullback got accelerated. It's as if someone poured gasoline on a small fire when a very esoteric exchange traded note blew up. And what started out as a pullback turned into a correction. And we're going to look at corrections so that they actually make sense to you in a way that you can understand what's going on in the market. So as we were moving up in 2017, Chaikin Money Flow showed you intense institutional accumulation. And we know that because there were extended periods of green, and we color the indicator green when it's above the zero line. Normally it fluctuates between red and green in a fairly sine wave pattern. So into the top, there was no indication, and that's why I say it's very difficult when you're in an accelerated move like we saw in January to know when the correction's going to begin. But now we've established a fairly predictable pattern, and we've made a series of lows. They happen to have come in at the 200-day average, which is very closely watched, particularly by institutional investors. If you ask an institutional investor, what's the one technical indicator you look at, he'll tell you the 200-day moving average. Now, when we bottomed out here initially in February, we rallied up and Chaikin Money Flow stayed red. This is a pattern we're going to get into in terms of individual stocks later in the webinar. Very powerful pattern. We've been teaching this to institutional investors for over 30 years, and it's a predictive pattern. So institutions went from pouring money into the market to somewhat of a skeptical posture relative to this rally that began off a bottom in the 25-30 area on the S&P 500. And then we came back down and tested that low, and that's a pattern that's known as a W-shaped bottom. And there was a lot of hand-wringing going on that second low. Oh my God, it's not going to hold. We're going to go down a lot more. And people on CNBC were encouraging you to be cautious or nervous or liquidate. And that never works, because as someone once said, and this is Liz Ann Saunders from Charles Schwab, panic is not an investment strategy. And Chaikin Money Flow stayed weak until we tested that low a third time, again at the 200-day average. Now it's moved up to 2,600. And Chaikin Money Flow has finally turned positive as we've gotten overbought here with a nice 5-day rally. So to sum up what we're looking at this chart, we've had a correction. It's been tested 2 or 3 times, and now we're sort of moving back up into that resistance area around 2,800, where the market's going to have to really attract a new set of buyers to continue the rally. Now, let's look at a little bit of a micro chart here. You can see the support at the 200-day average. You can see the downtrend line that formed, which was broken about a week and a half ago to the upside. And we actually extended out to new highs today before the market sold off late in the day. Now, today's late day sell-off is the reason that this webinar exists, because it came on news that the Korean summit might not take place, that President Trump was disappointed with the Chinese, and it highlights the fact that you need a disciplined game plan to make money in the stock market, and you cannot be swayed by the headlines. So we had a nice rally that broke the downtrend line. This is all very encouraging, and now we're going to back and fill a bit, in our view, as the market digests the recent advances. But to put this all into perspective, let's look at a 5-year chart of the S&P 500. Big move from 1,700 all the way up to 2,800 over the last 5 years. It's a 50, almost a 40, it was about 60% rally. Now, you see a number of sell-offs in this period, and I've labeled the first 3 of them. There was one back here on the left-hand side of the chart, V-shaped bottoms. We're going to explain the difference between pullbacks and corrections in a minute. And once we do that, you have everything you need to know to put the market into a context that you can understand. So V-shaped bottoms happen when you get a decline of between 5 and 10%. And that's why you'll hear on CNBC, buy the dips. Now, when you have a more complex and deeper decline of more than 10% in the S&P 500, you get a bottom in the form and shape of the letter W, and that's what happened in late 2015 and then again in 2016. W bottoms. Rally up, a couple more V-shaped bottoms. Now notice that there's a long stretch on this chart from the presidential election in 2016 through January of 2018 where there are no pullbacks. That's why I started the webinar by saying that we've gone from an uptrend on autopilot to a pretty steep correction, and we've now formed a W bottom. Now, this chart puts pullbacks into perspective. Since 1945, there have been 75, now 76 declines of between 5 and 10%. They average 6%, they're over in a month, and within a month you recover to new highs. So buy the dips actually works, especially in the context of a long-term uptrend. There have been 27 declines of between 10 and 20%. We call them corrections. And here's what's interesting. They typically average 13%. The current decline on an intraday basis, minus 13.4% from the high of 2873 in January. They typically last 4 months. This one began on January 27th. We're now May 22nd, almost 4 months in. So we're right on target for a typical correction in a bull market. And the good news is that within 3 months, they recovered to new highs. In this case, that would be roughly the 2870, 2900 area on the S&P. Notice that there are only 11 bear markets since 1945, roughly one every 6 years. Now, if you've lived through 10 of them, as I have, only as a sort of palliative, they're not fun. But on the other hand, if you're always looking for a bear market, you're going to miss out on all these other opportunities. So yes, you have to protect your capital in bear markets, but you can't be afraid of a bear market around the corner because they come very infrequently. So the most likely scenario for 2018 on this chart, which is courtesy of Bank of America Merrill Lynch, is higher interest rates and rising earnings. And that's the upper right quadrant, and that's a bullish scenario. So when you hear that interest rates at 3% are going to turn the market back down, and then they go to 310 and everybody gets a little bit nervous, it's the wrong perspective. Interest rates are going up because the economy is strong. First quarter earnings, partially aided by the tax cut that was passed in Congress in December, but also aided by strong revenue growth, buybacks, M&A activity. This is a vibrant economy. First quarter guidance, companies' view of where the earnings and the economy are going in the second quarter, very positive. So second quarter earnings are likely to be strong. They start coming out in mid-July. The period now between first quarter earnings season, which is over with Walmart's report last Thursday, and second quarter earnings is that period. It's almost like a vacuum where the market can be drawn up to new highs. So we're very optimistic about the stock market. And one thing we're not looking for is a recession. And recessions and bear markets go hand in hand. So we have 4 indicators we look at that you can monitor yourself. Doesn't take a PhD in economics to know this, that have always turned down prior to a recession, therefore prior to a bear market. The only bear market I've experienced, 1987, that was not accompanied by a recession. So a simple one to understand is the 12-month moving average of housing starts, and that continues to make new highs. That's turned down before every recession since 1960. Second indicator is what's known as the ratio of leading indicators to coincident indicators. It's released by the Conference Board, independent organization, so it's not government manipulated numbers. Always turned down before those shaded gray areas, which are the recessions. That made a new high just last week. So there's no indication of a recession. Therefore, I'm not worried about a bear market. I'll leave that to the commentators on CNBC. You've got to ignore those headlines, because if you're spooked by those headlines, you're going to miss opportunities. Now, in a period of rising interest rates, there's a very predictable set of industry groups and sectors that do well and sectors that do poorly. So on the left are the sectors that typically do well in periods of rising interest rates: energy, materials, technology, industrials, and financials. Upper right are the stocks that, or the sectors rather, that do poorly in periods of rising interest rates. These are the defensive sectors, typically have higher yields, rates compete with interest rates, with dividends for capital. So utilities, telecom, consumer staples, and healthcare. The outlier is consumer discretionary, and if any of you trade exchange-traded funds, the XLV is the XLY rather is the consumer discretionary ETF. It's dominated by Amazon, so it should be an outlier. But let's see if the real world performance over the last month has validated what's gone on over the last 75 years. And in fact, it has. Energy, technology, materials, and industrials have been the best performers over the last month. And at the bottom, utilities, consumer staples, healthcare, and real estate. The one outlier here is financials, and they may start to pick up as the interest rate climate stabilizes. Now, after all this bullish talk, if you still think there's a pullback coming, there's a very high probability way to profit from that pullback. It's known as a bearish vertical put spread, and I used our options play module, which comes bundled with Chaikin Analytics, to find a high probability bearish vertical put spread. In this case, we're looking at a put spread where you're buying the 274 put on the SPY that expires on June 29th, and to reduce the cost, you're selling the put with a strike price of 265 against the total cost of the trade, $233. If the S&P drops from 2740, where it was this morning, to 2650, which is sort of the middle of the recent range, you make almost 300% on your money. You can also protect a portfolio. Let's say you have a 401k plan with $270,000 in it, and you want to ride the market up over the next 5 weeks because you think earnings in the second quarter are going to be good, but you're a little bit nervous. You buy 10 of these put spreads, $2,300, and you protected that portfolio against a 3.5% to 4% drop in the market. It's a very simple, clean-cut, high probability way to profit on the downside if we're going to get a little bit of a pullback here. Now, in today's webinar, what my primary objective is to show you how you can identify stocks like Centene, which is the largest Medicare provider in America, who's done an excellent job. Even though healthcare has underperformed, Centene has figured out how to make money in the Medicaid world. They raised prices last year in anticipation that government subsidies would be cut. They've made an acquisition that's going to broaden them into 7 new states. And along the way, one of our methodical buy signals, something we call a relative strength buy, triggered back here in March when the stock was trading at 100 and it rallied up to 118. Now, on the left-hand side of the screen is an example of one of the new features of Chaikin Analytics. We enable our members to put a note on an individual stock chart. This is a great discipline. A lot of trading coaches will tell you that you should have a diary where you put your thoughts down and talk about what you're seeing when you're making an investment decision or evaluating a stock. So in this case, I said CNC, which is Centene, is a potential takeover candidate. I had read that in the Wall Street Journal. Watch it in my portfolio along with Humana, which is also a rumored takeover candidate. And then on March 28th, I noted that it was selling off with the market. Finally, that relative strength buy signal. This is the sort of methodical, focused approach that I encourage all of our members to use, and it helps you stay focused. So you can go back to that chart and see what you were thinking. Now, there's an awful lot of information to digest every day in the market. We call it information overload, and it can overwhelm you. So part of our objective in starting Chaikin Analytics was to distill all this information down into something that you could actually use in 15 minutes a day to monitor your portfolio, a watch list of stocks, and make intelligent decisions along the way. We call that Chaikin Analytics for both iPad and desktop, and all of the examples in this afternoon's webinar are going to be taken from Chaikin Analytics. We've been fortunate to have been written up in the press, Barron's, Forbes, be on CNBC, and to partner with people like Ed D'Agostino and John Mauldin at Mauldin Economics, and see that the rational bear will use a Chaikin idea as part of a bearish strategy that they develop using options. So lots of validation, and validation is important because you're giving up an hour of your life to listen to what we have to say, and it's important to realize that other people have embraced this. Now, as I said earlier, fundamentals drive the market, but emotions drive the market to extremes. Just look what's happened over the last 6 weeks, 6 or 8 weeks, where tweets and stories about meetings, tariff discussions with China, NAFTA, and so forth have created such emotional reactions. So the path to profits is to combine fundamentals with technicals, because technicals make sense out of the extremes in the market. Now, the Chaikin Power Gauge gives you the edge you need to make intelligent, profitable investment decisions. It gives you what I call a directional edge. Ed mentioned that I ran an options department at a major brokerage firm. The key to trading options profitably is to have a directional edge. Without it, you're just a chip on the wave. So we do that by combining fundamentals with technicals into a quantitative model, and then providing 6 pairs of buy and sell signals for better entries and exits. But at the heart of everything we do is the Chaikin Power Gauge. The display is very simple. It looks like the gas gauge on your car. It goes from very bearish to very bullish. But please don't confuse simple with simplistic. Under the surface, there's a lot of number crunching going on. This is a powerful quantitative model distilled down to an easy to understand display. I like to say on these webinars that the Power Gauge rating is like a Chevrolet with a Ferrari engine under the hood. And it can be your GPS during earnings season. Earnings season creates an enormous amount of volatility, and without some sort of guide to what's likely to happen and how to deal with it, you're pretty lost during earnings season. Now, we did a live teach-in with Jim Cramer back in October, and as I was showing the slide that's going to come up next, Jim live tweeted that Chaikin Analytics model is the best. I've used it at my old hedge fund. So this is what Jim Cramer got excited about. The Chaikin Power Gauge rating has 4 primary factors that looks at value, growth, technicals, and sentiment. And within each of those 4 factors, there are 5 sub-factors. 85% fundamental, just 15% technical, and it's based on everything I learned from my institutional colleagues and clients, those successful hedge fund managers, the people who run the mutual funds at T. Rowe Price and Fidelity and Invesco. They all have a discipline. They look at the same factors over and over again every day in evaluating stocks, make buy and sell decisions. The challenge in creating a model is that they all look at different things. So Warren Buffett, Seth Klarman, arguably the best value investor in America, look at things like price to sales and free cash flow to market cap. Someone like a Jim Cramer or a hedge fund that's more aggressive is looking at earnings-related factors, particularly earnings surprise and analyst estimate revisions. And then you've got momentum investors who are looking at the technicals and the sentiment. So the challenge in creating a model is to reflect the different styles and time horizons of the various market participants. The end result for me was the Chaikin Power Gauge rating. It works because it's based on how Wall Street works. This is not a model built by a newly minted PhD out of MIT, throwing what we call digital spaghetti on the wall. That's what got us in trouble in 2008 and in 1998, when two Nobel Prize winners blew up a multi-billion-dollar bond fund called long-term capital management. This model was created by a 50-year Wall Street professional who's lived through 10 bear markets, who understands how Wall Street works. Now, the performance of the model is impressive, and the reason is that models beat humans. This is from James O'Shaughnessy. He's written 2 books on factor investing, and he's also a successful money manager along with his son. And he said models beat human forecasters because they reliably and consistently apply the same criteria time after time, as opposed to human beings who are swayed by emotions and opinions. That's why we've had such a volatile market, people responding to the headlines. Now, if you've read any of Jack Schwager's books, the Market Wizard books, you'll see the same story. The successful traders and hedge fund managers that he interviewed all had a disciplined methodology, but they all looked at different things. So that's why the Chaikin Power Gauge is so powerful. Now, the performance of the model, very impressive. We use the Russell 3000 to measure the performance. The very bullish rated stocks in the Chaikin Power Gauge through the end of 2017, over an 18-year period, up 20%. Very bearish, up only 1%, and that's after a 9-year bull market. So you want to try and capture that spread by avoiding the bearish stocks in your 401k plan, focusing on the very bullish stocks, and then looking for put buying opportunities in the bearish stocks, even in a bull market. Now, in 2015, the power gauge was really important. Why? Because there was a bear market, not in large cap stocks, but in small cap stocks and energy. Excuse me one second. The average very bearish stock in the Russell 3000 in 2015 down over 17%. These were the Range Resources and the Kinder Morgans, the fracking stocks, the railroads who move that liquid around, the pipeline stocks. And it was really important to know about the stocks that had turned bearish so you could get them out of your portfolio. So the performance has been great. One more piece of validation. As Ed said, we've partnered with NASDAQ and created 3 NASDAQ Chaikin indices. There's a 4.5-year real-time track record. All 3 of the indices, large cap, small cap, and dividend achiever, have outperformed their benchmarks. And because of that, New York Life Insurance's Index IQ ETF subsidiary licensed them, launched the first one on May 17th of 17. The small cap ETF has almost 500 million in assets, and the large cap was launched in December. And the picture on the screen right now was taken on April 30th when we rang the opening bell on NASDAQ, and the Chaikin Power Gauge was up on the rotating NASDAQ tower for over an hour. So very proud for all the people here in Philadelphia at Chaikin Analytics. More importantly, the disciplines, the focused way to look at the market that I'm now going to describe to you is at work in the market in these ETFs every day. Now, these are buy and hold portfolios. They get put in place on April 1st, and they stay there. And the common element is that the Chaikin Power Gauge rating has to be bullish to get into these ETFs. And there they sit for another year. Now, you can be a much more opportunistic trader, or you can take the longer view. The Chaikin Power Gauge will point you in the right direction. So I've stressed over and over that successful investing demands a disciplined methodology, particularly in volatile markets. So at the top of this pyramid, which encapsulates what you need to do to be successful as an investor or a trader, is the Chaikin Power Gauge rating. and right under that, industry group and sector relative strength. These provide the tailwinds to your investments, your 401k plans, your swing trades on the long side. At the bottom of the pyramid, just two technical indicators. Don't have to overcomplicate it. Chaikin Money Flow, which has been around for over 35 years, and our unique way to look at how a stock is performing relative to the market. And then in the middle, that sweet spot, the buy and sell signals. So there's a pattern that's very easy to understand that thousands of Chaikin members have embraced over the last 5 years. We call it the classic Chaikin bull. The power gauge rating is bullish, which means that the fundamental potential for that stock is positive. It's outperforming the market, so the market agrees with the model, and Chaikin Money Flow is strong, telling you that institutions are accumulating the stock. And typically in these webinars, which we've been doing for over 4.5 years now, I'll pick a stock as our poster child for the classic bull, and then we're fortunate enough to stay with it for 6, 9, or 12 months because the fundamentals just keep improving. So here's E-Trade on a 1-year chart from Chaikin Analytics, and we do something very different. We read the chart from the bottom up. Most people look at price on the top of the chart. Now, why do we do that? We do that because the Chaikin power gauge rating, that directional edge, is at the bottom of the chart as a ribbon that goes from red to yellow to green. In the case of E-Trade, it's been bullish since June of 2017 when the stock was trading at about 36. Right above that is our proprietary way to look at how a stock is performing relative to the market. We look back over 26 weeks and convert it to a heat map, so it's very easy to know if a stock is outperforming or underperforming the market. And because of the way we compute this, it's very consistent. There aren't a lot of whipsaws. So beginning in July of 2017, E-Trade started outperforming the market. And what that means is the market agrees with the fundamental model. And the thing you need to know is that no matter how good your fundamental analysis is, if the market doesn't agree with you, guess who wins? The market always wins. My old friend Marty Zweig used to say, Mr. Market rules the day. So when you've got a bullish power gauge rating, which means the fundamentals are strong and the stock is outperforming the market, we then want to make sure that the institutions are still aggressively buying the stock. And in the case of E-Trade, that's been true for 12 months. Now we look at the price chart, and we see that this stock has been in a really nice uptrend, and as recently as this morning made a new all-time high. Now, I was talking to a reporter from CNBC yesterday, and I had a conversation with him the previous week. I pointed out that stocks like E-Trade and Interactive Brokers were making new highs, and I thought that was a very positive statement for the stock market. So we discussed why, and I'll just digress a little. Discount brokerage firms actually make money when interest rates are going up. They can charge more in margin accounts. Money market funds become more attractive, and the whole dynamic for discount brokers is positive in a climate of rising interest rates. So here you have a stock where there's a lot of trading activity going on and you've got interest rates going up. So this is your classic Chaikin bull. Now, it's wonderful to know that there's a pattern that works, but very early on when we started Chaikin Analytics, people said, how do I find these stocks? So we created a screener, and the screener is unique in that in addition to the regular set of factors that most screeners give you, we allow you to screen on the power gauge rating and the 20 factors within the ratings. So a little over a month ago, for a webinar that I gave, I applied a screen to the S&P 500. I could have been looking at the Russell 3000 if I wanted small and mid-cap stocks. And we were still in that volatile formation of the W bottom. So I was looking for stocks in the S&P that were bullish. And because we were in a volatile climate, unclear as to whether we would form that W bottom. I wanted free cash flow to be strong. This is the primary metric of a Warren Buffett or a Seth Klarman, any good value investor. It's the company throwing off a lot of cash. And then I put in our two technical factors. I wanted the stock to be in a rising trend and relative strength to be strong. Within seconds, we narrowed the S&P 500 down to 16 buy candidates. One of them was E-Trade at 56.67, which subsequently moved to 65. Another was Marathon Petroleum, which went from 73 to 83. The good news is I had a candidate, Micron, 49.77, trading at 59 today. Macy's, which reported a positive earnings surprise a month after I did the screen and skyrocketed. The key is to have a focused list of stocks to be monitoring for buying opportunities. Now, the classic Chaikin bear is extremely important. Why? Because even in a bull market, there are stocks that you need to avoid. So just turn everything I said on its head. Power gauge rating is bearish, meaning the fundamentals are negative. It's underperforming the market, and Chaikin Money Flow is red, not green, telling you that institutions are selling the stock. What we're looking at here is a one-year chart of Tesaro, which is a biotech and drug company. And it started out with a market cap of about $8 billion back here a year ago, and now down to about $3 billion. Why? Because the stock has dropped from 160 to 46 in a period when the market was making new all-time highs. If we read the chart from the bottom up, we see that the Chaikin power gauge rating has been bearish for over a year. I've been using Tesaro in these webinars for over 7 months now. Right above that, the relative strength indicator tells us that it's underperforming the market, so the market is agreeing with the model. Chaikin Money Flow is showing that institutions continue to sell the stock. And then we look at these relative strength sell signals for entry points for bearish positions. Bearish vertical put spreads, short sale of the stock. If you're unfortunate enough to own it, you want to get out of it in your 401k plan. Let me just tell you how simple a sell signal can be. A relative strength sell signal occurs when a stock that's been underperforming the market moves above its 21-day average and then drops back below. It works best if the power gauge is bearish, but it also works in stocks with a neutral power gauge, as we'll see in a couple of minutes. Now, the value of this signal is enhanced by the fact that not only is it successful 70% of the time, but the signal lasts for 4 to 8 weeks. So you can use it as a swing trader to buy a vertical put spread, give yourself some more time, not be under the gun in terms of the expiration of the option. You can short the stock. But knowing that there's likely to be a 4 to 8 week move 70% of the time gives you the confidence to pull the trigger and do the right thing. Now, there are 3 other profitable patterns that we've identified. One we call the dynamic duo, one is personality changes, and the other is that special secret pattern in Chaikin Money Flow that you won't see on any website or in any books, because we've kept this for our members and our clients. When we had institutional clients, they really keyed in on this signal. So what is the dynamic duo? Well, it's that combination of fundamentals and technicals that we talked about at the beginning of the webinar. The dynamic duo finds big winners and losers, with one caveat: relative strength stands alone as a bullish or bearish indicator. Now, what do we mean by that? Well, all of us have traded momentum stocks, which very often are stocks that have captured the fascination of Wall Street, where the stock price and the fundamentals have a basic disconnect. And if you're trading a momentum stock from the long side, you're on a high wire without a safety net. As long as everything goes smoothly, you can make a lot of money in these stocks. That happened in 1999 and 2000 when the internet boom was going on, and it happened in 2007 and the market peaked. happen in cloud computing stocks, 3D printing stocks in this bull market. But the bottom line is that you can make money in a stock that's outperforming the market, but if the fundamentals don't support that, then you've really got to be very strict with your stops. Recognize that there's a big price to pay when the company disappoints, and this happens all the time. So that's the dynamic duo. The key to making and keeping profits is to be able to spot personality changes. We define a personality change as a stock that's been outperforming the market, which begins to underperform the market, or vice versa. It's really important to spot these personality changes, and the reason is that as traders and investors, we tend to be stubborn and put our feet in cement. Analysts do it, money managers do it. I've done it in my career as a trader. We fall in love with the stock, but the stock doesn't know that we own it. So you've got to be objective, and spotting personality changes is one way to remain objective. So here's an example of a bullish personality change. Michael Kors was unloved back in the spring of 2017. People were talking about border tariffs, which would negatively affect their business. And then they reported a very strong quarter back in August of 17. The stock spiked up, broke the downtrend. Power gauge was already bullish, but the stock was underperforming the market. And with that spike up, the stock began to outperform the market. And we got what we call a bullish personality change. Michael Kors went from underperforming to outperforming the market. Now, when that happens, you don't chase the spike. You wait for a pullback. And in this case, we got an oversold buy signal, which is a new 8-day low in a stock with a bullish power gauge rating. And there was your entry point. The stock was trading at about 43, and it went up in a pretty straight line all the way to 67. And look at the Chaikin Money Flow. So you had all three of the pieces we've been talking about: the power gauge, relative strength, and institutional accumulation supporting a big move in price, and then these periodic buy signals along the way. So there's a bullish personality change. Here's a bearish personality change in a tobacco stock. Now, tobacco is in the consumer staples sector, which typically does poorly in a period of rising interest rates. It's also a stock that's interest rate sensitive. So we had a bearish personality change back in August with the stock at about 112. Whole series of sell signals along the way, institutional selling, bearish power gauge rating, and then the ultimate disaster, a bearish earnings surprise back in April. And the reason I used Philip Morris is that my associate Dan Russo, who writes our morning market commentary, put out a sell recommendation in early April on Philip Morris 2 days before that bearish earnings report, and the stock dropped from 102 all the way down to 80 in the course of a week and a half. And notice that the institutions never stopped selling it. So this is the power of spotting the personality change back in August and then looking for opportunities on the short side along the way. Getting out of a stock like Philip Morris, even though it has a high dividend, is one way to build capital. Why? Because you take a stock out of your portfolio that's going to destroy capital. Now, the third pattern is my favorite. It's based on Chaikin Money Flow. We call it the secret sell signal that 95% of traders never see. It's a Chaikin bearish money flow sell alert. And I'm going to show you a chart that ends in 2017 for advanced auto parts. In January of 2017, advanced auto parts made a new high, and Chaikin Money Flow, which should have gone green or positive, stayed negative. Institutions were selling into strength on all the auto parts stocks: AutoZone, Advanced Auto Parts, O'Reilly. We call that a money flow sell alert. If smart money is selling into strength, you want to be out of that stock. You want to be selling along with them. Now, right after that, the power gauge turned bearish at the bottom of the chart. That bearish money flow sell alert came at around 170. You got a bearish personality change, so now the dynamic duo that we talk about was weak. And along the way, you got some sell signals, particularly ahead of earnings that turned out to be disappointing, and the stock dropped all the way from 170 to an ultimate low of 78. This is a very powerful pattern. If you can find this, whether it's on your online brokerage platform, on Chaikin Analytics, you're going to find some wonderful trades and get out of some stocks ahead of the crowd. Now, I want to show you sort of the full cycle of a stock. And I'm going to use a stock named D.R. Horton, which is a home builder that's really had a good track record. They build homes for first-time home buyers. And in September of 2017, in my weekly market letter, Market Insights, I made this my bullish stock of the week at 36.90. So let's see why I did that. We're in September. Again, we read the chart from the bottom up. Chaikin Power Gauge is bullish. D.R. Horton's outperforming the market, and there's big institutional buying going on. And it pulled back to the 21-day average. And I thought this is a good opportunity to make this my bullish stock of the week. It went just as Michael Kors did on that other chart in a straight line from 36.90 all the way to 52. Now, along the way, institutions kept buying it. But on that final drive to new highs, look what happened. Chaikin Money Flow stayed negative as D.R. Horton went up to the upper volatility band, price of about 52. That was your red flag to get out of the stock. We had a lot of members who rode this stock up, but when they saw that bearish money flow as the stock was making a new high, they said, time to take money off the table, and more importantly, ignore the next buy signal. So you got an oversold buy signal down here as Barron's was recommending it. And look what's happened. In spite of the fact that housing starts are going up, in spite of the fact that there's a lack of supply in the housing market, in the resale housing market, stocks like D.R. Horton, Pulte, Lennar, Toll Brothers, who reported disappointing earnings today, are underperforming. Now, part of that is rising interest rates. Part of that is a big increase in the price of lumber, which has gone up over 40% in 2018. And now these relative strength sell signals are actually starting to work, and D.R. Horton's making a new 6-month low. But the key is we went from a very bullish set of credentials, the Chaikin indicators, power gauge, relative strength, money flow, very strong, to that bearish money flow sell alert that can be fatal. Now, one final example, this is a company in the electronics area called Trimble. Again, my associate Dan Russo put out a sell recommendation here with the stock at about 38 and change, based on what? Power gauge bearish, underperforming the market, institutional selling as the stock rallied from 36 to 39, and then our overbought sell signal. And that was a mini money flow sell alert because Chaikin Money Flow stayed negative even though the stock rallied 10%, dropped back to 34, and then you got a second chance, and up here I made it my bearish stock of the week. So what I'm trying to do is to, in essence, let you look over my shoulder at how I find stocks and how my associate Dan Russo, is one of the best technicians I've ever met, find stocks. Now, here's an example of how you take advantage of volatility. He and I both had short sale recommendations on. When they reported a negative earnings surprise 2.5 weeks ago, the stock spiked all the way down below 32, and we looked at each other and said, time to cover the shorts. Take advantage of that spike to the downside and rein in the shorts and book the profit. But one of the key components for both of us was the fact that Chaikin Money Flow showed that institutions were continuing to sell the stock. Now, everything we've been looking at is what Warren Buffett calls the fat pitch. Warren Buffett has famously said that they don't call balls and strikes on Wall Street, so you don't have to swing at every pitch. You can wait for your pitch. He calls it the fat pitch. We call it the ideal setup. Missing ingredient are the entry points, the buy and sell signals. So 6 pairs of buy and sell signals in Chaikin Analytics. You can go to our website, chaikinanalytics.com. We explain them, whether you're a member or a guest. We tell you the rationale behind the signals, and we've explained a couple of these on the webinar. The key is you have to have a disciplined way to enter trades, whether you're an investor or a trader. And so we have a dashboard that shows you all the signals in any of the lists you're following or any of the indices or ETFs. So in this case, for a webinar I did about a month and a half ago, I took a screenshot of the stocks in a 40 stock list that I monitor that had given buy signals, and Marathon Petroleum, which had a bullish power gauge rating, gave what we call a money flow buy. The stock was 72.60. The signal came at that yellow arrow, and the stock immediately took off and went to 83 when they announced a takeover bid for another big refiner. It's going to make a powerhouse, largest refiner in America. And of course, you want to sell the spike above the upper band. The key message here is to trade more profitably, follow the signals, because it's a discipline. And anytime you trade on a discipline, it's better than trading on your emotions. Now, we added a new feature to Chaikin Analytics just 2 weeks ago. We now email the alerts on the stocks in your list and any other list you want to follow. So the second day of this capability, I got this email at 9 o'clock in the morning, and I immediately zeroed in on a company called Envision Health. This used to be American Surgical Centers, and it had been beaten down because it was a rumor takeover candidate, but then United Health said, we're not interested. So what did I learn from this email alert? Number one, EVHC had an oversold buy at 36.90 based on the previous night's close, and they had just reported a positive earnings surprise. So they beat Wall Street estimates. So now I have the complete picture. The stock is oversold, but earnings came in better than expected. And that's what the chart looked like. You could have bought the stock the next morning up about 40 cents at 37.30, and then a story appeared in the New York Post that KKR was interested in making an $11 billion bid for the company. And because of that email alert, I was able to tell our members that this was an interesting buying opportunity in a stock with a bullish power gauge rating that had weathered some bad news, and the stock went from 37.30 to 44. So powerful new functionality at Chaikin Analytics, again, trying to solve that information overload problem. Now, we talked about the volatile market we're in and how that can lead to very profitable swing trading. Because when you combine a volatile market with fear, you get opportunity. So the discipline is very simple. Follow the power gauge ratings. Try and look for buying opportunities in bullish rated stocks in strong industry groups, and then use one of our rule-based entries to time your trade. Now, many of you have your favorite entries, whether they're candlestick patterns or moving averages. We give you that 6-pack of signals to make this trading easier. So let's look at some opportunities to take advantage of volatility that have happened recently. All of these are stocks that my associate Dan Russo made bullish stocks of the week in his, of the day in his morning insights. Interactive brokers charts look very much like E-Trade. Very typical that stocks in an industry group will trade in sync with one another. Buy signal down here at 65 on the way to 77. Valero Energy, same industry group as Marathon Petroleum, pulls back Power gauge is bullish. It's outperforming the market. You buy the stock at 90 because it's in a strong industry group. Those macro trends work in your favor, and you get a really nice trade of over 25 points to the upside in about a month and a half. On the downside, Colgate, another consumer staple stock. We saw that this is the weakest industry group over the last month and 3 months. Soaps and cosmetics, Procter & Gamble, Colgate, under pressure. They're sort of being Amazonized as packaged goods become a commodity. Sell signal, negative money flow. There's your sort of mini money flow sell alert. Stock at 72. Bearish earnings report goes to 62. Volatility can be your friend if you have the right tools. So one final way to look at how to manage your money is to play good defense. And very often good defense leads to good offense. It worked for the Philadelphia Eagles this year. It can work for you in the stock market. So playing good defense can be as simple as knowing what stocks not to own. Herb Greenberg, very smart, articulate analyst on CNBC and TheStreet.com, said in January of 2014, it's the stocks you don't own that matter. Too many of us are looking for the next big winner, the next Facebook, or the next trend in the market, but it really is all about protecting capital. You got to avoid stocks in weak industry groups, know what stocks not to buy, and that means no bottom fishing. We're going to show you that in a minute. You're going to improve your performance by eliminating bearish rated stocks from your 401k plan. You're going to spot personality changes so you don't get stubborn, and buy bearish put spreads on weak stocks. That's playing good defense. So let's look at a couple of examples. Albemarle Corp, chemical stock in the S&P 500. Reading the chart from the bottom up, everything we've been talking about. Power gauge rating bearish, underperforming the market, negative Chaikin money flow, bearish money flow sell alert. I made it my bearish stock of the week at 133 back in early January, and immediately they gave us some negative guidance. The stock dropped all the way to 100, rallied up ahead of earnings. We got a sell signal, dropped again. This is typical of how you play good defense. Identify these stocks, spot the personality change, and then look for opportunities on the downside. Now let's have a little fun to end the webinar. I was quoted on the Kramer webinar as saying bottom fishing is the most expensive sport in America, and I mean it. So say goodbye to bottom fishing. On the lower portion of this chart, I extracted the technical indicators from a stock that we actually used as our poster child for the classic Chaikin bear 10 months ago when we did a webinar to the Mauldin Economics community. Power gauge was bearish, been underperforming the market for a year. There had been a lot of institutional liquidation, and then there was some buying going on. And we said on that webinar that this was not a stock to be bottom fishing in. The stock was Under Armour. And this chart ends in June of 2017 with the stock at about 21. Everybody on CNBC was saying, the selling is overdone, the stock is cheap, time to take a position. The power gauge, relative strength, was saying, don't do it, don't bottom fish. And now bringing that chart up to date, we see that the ultimate low in the stock was 11. So this stock went from 42 with the power gauge bearish all the way down to 11. There's no way to know the bottom. Now what's happened is that the power gauge has turned neutral and we've got a bullish personality change. And guess what's happening? The relative strength buy signals are working. Notice how the sell signals worked all the way down. Better than 70% accurate. Even with a neutral power gauge, and remember I said relative strength stands alone as a bullish or bearish indicator, and this is what I mean by it. If you like Under Armour, now you've got relative strength on your side, money flow is improving, and these relative strength buy signals when the stock dips below its 21-day average and then moves above are actually working. The stock has moved from 16 to 20. Now, give you a second example. This is an example of a stock with a neutral power gauge rating that was underperforming the market for a year. And look at that institutional selling. Does anybody have an inkling as to what this stock might be? Well, if you guessed General Electric, you guessed right. Because General Electric was in a 2-year downtrend, neutral power gauge rating, underperforming the market, huge institutional liquidation. And then about a month ago, look at the bottom right-hand portion of the chart, Chaikin power gauge turned bullish. And we did a segment on Jim Cramer's Off the Charts on May 1. We recommended Marathon Petroleum, EOG Resources, and General Electric. Jim Cramer was blown away because this is one of the holdings that has caused him a lot of pain in his charitable trust. Going to reprise that segment tomorrow on Off the Charts on Mad Money between 6 and 6:30 because these stocks all worked out so well. But the key was that the power gauge rating saw a change in the analyst's outlook toward GE. Now there are positive news stories coming out about joint ventures, and new management is kicking in and doing some things right that had not been right previously. And the stock has done extremely well. It's gone from 14 when the power gauge turned bullish to 1550 today. And it looks like there's more to go on the upside. So bottom fishing doesn't pay until the power gauge tells you that things are changing. Now, one last stock that I've been featuring for a year and a half in webinars is Tesla. The power gauge rating has been bearish since last July. And this is one heck of a tough stock to go short because Elon Musk had mesmerized and captivated Wall Street. But I think people are starting to see that the emperor has no clothes. So our approach to Tesla is avoid the stock and look for selling opportunities when it rallies up. You can only sell this stock on rallies, and you've got to use options because you can get involved in a short squeeze. So on a webinar I did on May 11th, Tesla had rallied up to 311. And on that webinar, we suggested, or May 10th rather, a bearish vertical put spread. The cost of, in essence, shorting 100 shares of Tesla, which is a $300 stock, for 6 weeks was $1,400. The stock has dropped from 311 to 275 today. That spread is now doubled in price. So this is an example, taking advantage of volatility, waiting for the stock to rally, and putting on a sensible high probability options position. So everything we've looked at helped us win the Benziga FinTech Award a year ago in May in New York for Best Ideas Platform. This year we won Best in Show. Powerful platform to generate profitable ideas, as Ed said, helps you cut through the clutter, monitor your portfolio, find new ideas. And we call this Chaikin Analytics. It's a proven stock selection system. It incorporates our 20-factor model, the power gauge rating, also our stock discovery engine, which our members get a full-blown education in, the way to find new ideas by seeding it, the way Netflix or Spotify helps you find music or film. We've created a cutting-edge discovery engine. You read a lot about artificial intelligence in the stock market now. This is real intelligence. This incorporates the power gauge, industry group strength, the factors that really matter. So all of this comes with our screener that you've seen, our options ideas, and Chaikin Analytics normally sells for $2,195 for an annual subscription. You can go to chaikinanalytics.com/Mauldin to subscribe, but as a special discount for the Mauldin Economics community, we'd like to offer a webinar special and take $200 off the price of an annual subscription, reducing it to $1,995. chaikinanalytics.com/Mauldin. This offer expires Friday, May 25th, or you can call the number on the screen or email us at sales@chaikinanalytics.com. Now, John Mauldin was kind enough to give us a really strong endorsement. He said, "I'm impressed by what Marc has done. My analysts are enthusiastic users of Chaikin. Marc's system has been integrated into our routine due diligence process for vetting and evaluating potential investments." Couldn't get a stronger endorsement from a highly respected market analyst. In addition to everything you've seen, you get intraday charts, our earnings alerts, and my weekly market insights with a bullish or bearish stock of the week. Plus, as a Chaikin member, you get access to our weekly strategy webinar with our market strategist, Dan Russo, unlimited coaching, including one-on-one coaching if you want it and need it, and Dan Russo's daily morning insights, which come to your inbox before 9 o'clock every day. So as an added inducement to encourage you to become a member of the Chaikin Analytics community, and by the way, there are over 500 Mauldin Economics subscribers who are already members of the Chaikin community, we'd like to take an additional $200 off. If you subscribe by midnight tonight, the cost of a one-year subscription to Chaikin Analytics, only $1,795, and you'll always be grandfathered at that price. We've only had one price increase in 5 years, but if we have another, this price is locked in. So chaikinanalytics.com/Mauldin. With that, I'd like to once again thank Ed D'Agostino for turning out a huge crowd. And Ed, do you have any final words you'd like to say?
I just want to say thanks, Marc. I appreciate the courtesy you're giving the Mauldin Economics readers. Very, very much appreciate it. And I would strongly encourage anyone who is thinking about it to contact Marc if you have any questions. I get a lot of value out of this system. I don't think you'll be disappointed.
Ed, thank you very much. I'd like to turn the webinar back to Josh Mindlin, who will talk to you about the recording and who's now put up the subscription link in the chat box. So Josh, take it away.
Thank you, Marc. Thank you, everybody, for attending today. In the chat window, you can find the link to take advantage of the special offer, to take advantage of our offer. The link is chaikinanalytics.com/Mauldin, or you can call us at 877-697-6783. We run, as Marc mentioned, many member sessions every week, offering one-on-one coaching as well. We have an onboard session that we do 3 days a week. You can be on that tomorrow if you would like. You can join us tomorrow on that onboard session to get you up and running. Again, the link is in the chat window, chaikinanalytics.com/Mauldin, or call us at 877-697-6783. Thank you all for attending, and I look forward to seeing you in a future session.